Welcome to the Global Investor Podcast, a show that focuses on helping foreign investors enter the lucrative U.S. real estate market. Host Charles Carrillo combines decades of real estate investing experience with a professional background in international banking to interview experts in all areas of U.S. real estate investing. Now, here's your host, Charles Carrillo.
Welcome to another episode of the Global Investors Podcast. I'm your host, Charles Carrillo. Today we have Colby Bowers. Colby is a wounded warrior, having served in the military for 23 years and now is a full-time real estate investor. Over the past 36 months, he has acquired over 600 rental units and expanded his company into 4 states. As a wounded warrior, he has a passion for giving back to his community by helping homeless and struggling veterans and supporting first responders. So thank you so much for being on the show, Colby.
Oh, thanks, Charles. It's always a pleasure. So glad to be here and looking forward to this.
Awesome. So give us a little background on yourself, both personally and professionally, prior to getting involved in real estate investing.
Yeah, well, like you mentioned, I was in the military for 23 years. So I was raised in South Florida and didn't know what I wanted to do when I got graduated high school. So took a summer off and still didn't know what I wanted to do. And so joined the military. And I think I was pretty much destined to join anyway. My dad was in during Vietnam, both grandparents, Korea, World War II, World War I, all the way back to the Civil War, so definitely a long military heritage. So ended up joining, was only going to join for 4 years, joined for the benefits and to get that college education. And 23 years later, finally decided to get out. Ended up loving it, got a lot of great experiences, a lot of great friends, and really helped me develop into what I'm doing now. And I actually cut my teeth in real estate while I was still active duty. So bought my first residence in my main home back in 2001. And it was right before 9/11. Got to the unit I was with right after 9/11. We ended up being deployed a lot. So I probably did, out of 5 years that I was actively deploying with that unit, probably accumulation total of 3 years, I actually spent deployed. Wow. And the significance of that is I instead of coming back and buying a brand new vehicle or, wasting money, I ended up saving it up and bought my first rental unit. And after 6 years in that unit total, when I left there, I had 6 units and never looked back.
Nice. So you utilized your VA benefit when you're getting the mortgages, so 0%. Is that was the plan, or was kind of like the VA kind of, not that it falls into your lap, but that's a huge perk? Is that you just want to utilize that, and that's what kind of got you into it, or did you see it from another reason why you got into real estate investing?
Yeah, no. So, I've always kind of had that entrepreneurial mindset. I knew, once I got out of the military, I kind of wanted to start my own business. Had no idea what that was going to be, but, kind of knew I wanted to be my own boss. And really, when I bought my first property, it was just for myself. I knew the unit I was going with, we were going to be what they call high ops tempo. And this was even before 9/11. So I knew I was going to be gone quite a bit. And I had been renting in my career up until then. And I knew with as much as I was going to be gone, why it didn't make sense in my mind to pay rent for something when I'm going to be gone, potentially 4 to 6 months out of the year. Yeah. So I might as well buy something and at least it'll appreciate, And so that was my initial mindset. I didn't have really much interest, knowledge, or anything into real estate. It wasn't until, so that was 2001. It wasn't until like end of 2003, first part of 2004, when I was like, wow, look at what the housing housing's doing. It's increasing, appreciating, and took that leap and bought my first one. And, that was probably my scariest decision. There's a lot of unknowns because I was still, like I said, active duty, didn't know how to do it. I was in my mid-20s. And, all those units I bought, I was with the high ops tempo, I was still self-managing because I received bad well-intentioned, but bad advice. Of, don't, hire a property manager, you're wasting 10%, you're throwing money away. So I was, had the added stress of being halfway around the world and still trying to, manage lease residentials. When I left that assignment, I knew I couldn't, I was moving basically halfway across the country, and knew that I wasn't going to be able to do it on a full-time regular basis. So I hired a property manager and was really kicking myself, because after the first month of having, I was like, wow, look at all this extra time. I don't have this stress. Why didn't I do this, 3 years ago, 4 years ago when I got into this? So now I'm a huge proponent of property management. I don't manage anything myself. I hire the managers and I manage the managers now.
Nice. Okay. Yeah. I want to circle back to that once we kind of get through what you guys are doing now. But what did you started flipping houses after you came back, or were you just, how did you get into what you're doing now, which is larger multifamily, I guess long-term investing?
Yeah. That's a good question, because, I knew I wanted to, I had the real estate bug. And I was like, wow, I loved it because it was, it's a tangible asset. It's fairly, recession resistant. I survived the crash of 08 and 9 through diversity. I love the tax advantages, and, I can go out and actually touch what I own, what I'm a partner in. And so I knew I wanted to stay into that, and I knew I wanted to grow. I just didn't know how. So I only stuck with what I knew. And it wasn't until actually around 2016, right into 2015, 2016, as I was getting ready to retire, that I was like, you know what, I want to get into the commercial. I know that's where I want to get. And so I started listening to a bunch of podcasts, reading blogs, just a lot of self-education. And that's where I learned about, syndication, joint ventures. And I was like, all right, cool. What's this syndication thing? I know the book answer, and everyone's like, oh, it's so easy. But nobody back then was like, well, how do you break it down? What does that look like? Nobody really talked about it. And so, kind of fast forward, and I attended my first conference, real estate conference or boot camp. And I was hesitant, did a lot of research, because I'm like, all right, what's the upsell? Is it going to be worth it? Is it, really educational? So I did some networking, found a really good program, and bit the bullet and spent like, $200 on a ticket. And then I had to fly. It was in another state. So at that point, I lived in Colorado, where I'm still living, but this was in Chicago. So I was like, wow. So not only did I pay a ticket, now I'm getting on a plane, rental car, all that's expense. I'm like, this better damn well work. It better be worth it, right? And it was looking back, it was the best decision I made to get where I am today. So that boot camp was very informative, very informational, had limited upsell, and so the light bulb went off. They actually peeled the curtain back and was like, this is a syndication. This is how you break it down. And I was like, wow, okay. I don't need a PhD to understand this and do this. It's a lot of work. It is hard work. There's nothing easy about anything in this, but I'm like, I can do this, and that was my mindset. And so I just, really dove in from there and found some mentoring, networking, and and went from, having nothing to knowing nothing. I spent probably a good 6 to almost 12 months of just really learning. Didn't dive into anything, was just, learning as much as I could, calling brokers, underwriting deals, learning markets, figuring out, trying to figure out where I wanted to put my feet and invest. And then, did my first deal as a limited partner and got to really peek behind the scenes. That was part of my thing when I invested with this group. I had built a network, and I was like, hey, I'll invest, but I want to see, how do you do the due diligence? How do you set this up? The broker or investor relations, and this was on a 300 plus unit portfolio.
Mm-hmm.
So it wasn't small. And I was like, went through the whole process and I was like, wow, that's not hard. It's just you follow the checklist, you get the right components in.
Mm-hmm.
And so it was a great confidence builder. And so jumped in with both feet, and here I am today, and I'm still saying yes and figuring it out.
Yeah, it's the first time I heard about, someone gave me a book. It was Gene Troberg's Bridges book. It's a whole new business in like '08 or something. And I just bought like probably my second multifamily property. And I was like, this sounds terrifying. Like the amount of stuff for syndication. I was like, not interested. I'm going to buy my little stuff little by little myself as I was doing. And obviously you get to a point where you run out of, money and all the kind of stuff that happens with it, and you want to grow your business. So it's kind of the next step, but very interesting. Yeah. It's from the onset, it's very complicated of how you're going to structure everything, but it comes together and it's a lot of work, like you said. But so what do you, for your investment criteria now? I mean, you're investing in mobile home parks, smaller multifamily, larger multifamily. So what do you guys look for, and what is your strategy after you've acquired it?
Yeah. So our criteria for the multifamily, it's different than our mobile home park. So I'll kind of cover both of them. So really, I'm looking at 20 plus units on the multifamily. 1970 to 2010 vintage. It's kind of where I really focus. I'll look at stuff on either side, depending on the market and the asset itself. And then on the mobile home park side, looking at pretty much 50 plus pads or more. Prefer tenant owned properties where I own the dirt and the infrastructure. They own the homes. They pay lot rent, decreases your operating expenses. We will look at, and I do kind of like the tenant owned parks. The park owned homes. But as long as we can pick it up for a good price, and we can convert them to tenant owned. And so that's kind of where we look at the mobile home parks. And then, we kind of look in the similar MSA. So maybe with the multifamily, I'm more in depth into an MSA. A lot of the mobile homes seem to be kind of more on the outskirts, at least in the markets we're in. So at least I know the markets, I know property management, resources, everything in there. So we're just adding another asset class to the markets we're currently in.
Nice. Okay. So let's talk about those markets, because it's Indiana, Arkansas, Florida, and there's one other state which I don't know that you're invested into. How did you pick those? And like, what do you, or, I mean, you don't have to go through each state, but really, what are you looking for when you're picking that MSA, right?
Yeah, with these, it was a combination of having some firsthand knowledge of those markets. So I either lived there, knew people that lived there, or stationed there, and or had spent some time, or knew folks that were intimately knowledgeable in those areas. And then also, is market research. So not only having the intimate knowledge, but also going in and, what's the demographics, what's the population growth? How is it, how has it done over the last 20 years? Unemployment, how did it do during the recession? When we had the big downturn, so there's a whole lot of pieces into that. And, I really look for smaller markets. So, everyone's like Arkansas, Indiana, Florida. Everyone's like, oh, cool, Florida. You must be like in Tampa, Orlando. No, I'm in Pensacola. I am in Indianapolis and around that MSA. That's probably my largest market, but I like smaller markets. I like with great demographics, but they fly under the radar of most other investors. So I don't need to be in the sexy markets. I don't care about Dallas, even in my backyard of Denver. I keep an eye on those. Don't get me wrong. If I find something and it makes sense, I will invest. But I'm putting most of my efforts into markets that I don't have a lot of competition. And so that's kind of what I'm doing, is focusing on that, because I consider myself very conservative. There's people that are more conservative than I am in my team. There's some that are less, but I like to be able to take my time, look at it, and I don't want to get into a bidding war, and I refuse to, because one is that's going to gets people in trouble where they overbid and they overpay, and it may not affect me, but the bottom line is I'm still have to be a fiduciary for my investors. So That's my mindset of looking into. And, I don't want big swings. I'm older. I've had enough stress in my military career, being shot at, blown up, things of that nature. So I like slow, steady climbs. I don't like big swings. I don't want a heart attack. I don't like all that stress. So I like dull, mundane markets that I can find good deals, get good, buy it for a good cap rate, do some great value add, and offer good returns.
Nice.
So,
and definitely landlord friendly states, because Arkansas being probably the most landlord friendly state in the union, I believe, right?
One of the most, yes.
Yeah, that's awesome. So how are you sourcing deals, and let's say, how have you sourced deals, and how are you sourcing deals now with where we are in this like crazy marketplace? And I imagine I know a lot of people that are looking at Indianapolis and other areas that you've mentioned, even if they're not as sexy as Tampa or Phoenix, but so, I mean, how are you competing and with those markets? And are you working with brokers? I imagine you're working with brokers. Are you doing any other methods as well?
Yeah, what's interesting? I haven't bought a property from a broker in over 18 months.
Nice. Okay.
So I still maintain the relationships, but and they still send me stuff, but it's not. I wouldn't call them deals. They're sending me properties to look at, but I haven't seen a deal from a broker yet. And which is fine. There is a lot of money out there, and there's a lot of investors that are coming in from out of state that, they can pay cash for some of these properties, and that's great. That fits their business model, whatever. That's not me and how we operate. So, when the pandemic first kicked off, we were still getting a lot of deals or a lot of properties to look at, but they were still pre-COVID pricing. A lot of the expectation of sellers and brokers still hadn't caught up with the reality of the times. So we shifted, and we started going direct to seller. And really, all my deals in the last 18 months, so I've closed 3 this year so far, have 1 more in the books, all off market, direct to seller. So either through, we've had a lot of success through doing cold calls. So we hired a VA, we're pulling lists. We've tweaked a cold call script. She calls, generates those warm leads. We follow up and get them to close. We're working at implementing a mail campaign now.
Nice.
To keep that top of mind, to keep that going. And that's, we're finding out that a lot of sellers are, especially 100 units and below, is where we're seeing the most success.
Yeah.
It's why I'm looking at 20 units and above. And we're really targeting up to about 75 units. And then we're finding more of the mom and pops where they don't want to deal with brokers. They don't want the hassle. They just want to, they want to sell it. They want to, sell it quick. And they want a good price. And we're able to, work with them in a lot of aspects. And so that's been how we, that's gotten us through so far.
Yeah. The 20 unit and above, I mean, that little niche there, it's fantastic, because with 20 units, it actually makes sense. You can really cut your management fees from having, 5 units or 3 to 5 units to 20 units. It's quite a dramatic cut of your management fees. Maybe you're going from 9 or 10% down to 7%, right? 6%, whatever it might be. So you really getting a lot of it, and to kind of go from there, you've really got to put up more units. So you're getting the beginning of that decrease in fees. And then the other thing too is that you're just you're not competing with buyers usually from out of state, right? And that's one thing, like when we're looking at stuff in Florida and everybody and their mother wants to invest here, and it's something that we have to put together like portfolios. I mean, you and I were on a deal 2 or 3 years ago, and it was a portfolio that we did in Tampa, and it was the only way of getting that per unit price down. And but you have a lot of people that look at that and go, no, I want one property, one address, all the kind of stuff that you're told when you read any type of guru program or anything like that. And that's what they push, which is definitely the best. I mean, if you can find a 150 unit building that's not overpriced, buy it. But the thing that was that, where's that broker really going to send that? They're going to send it to someone that's closed 10 of those in the last 2 years and, can pay for it and has a different return requirement than probably you and your investors do. But let's talk about funding deals. I mean, I think one of the best things about going direct to seller is that the ability maybe to put together some seller financing And then also maybe before going on to that, tell me about your VA. Like, where's your VA based? If we'll talk about this first, like, where's your VA based and how'd you find them and who trained them?
Yeah. So our VA is based out of the Philippines. Found her through Upwork.
Okay.
So it's a great place, got a great price. She has cold calling experience in real estate.
Okay.
So the train up period was very small, and so we use Mojo Dialer as well. So it's, for those that aren't familiar, and we load it up, and then she can basically hit buttons, and it's kind of like an auto dialer. So it helps make her a little bit more efficient. So instead of dialing individual numbers. So, we've had those in place. She had experience with that. And we just, hey, here's our call script. Here's what we want you to focus on. And then here's our parameters. And it's worked out great. Like, we don't have her get a lot of information. It's like, are they interested in selling? Verify, if they'll give a price, can we get, verified number of units? Because a lot of these lists, may be off a little bit, and then, when are they looking to close? And then, so it's just maybe a 5-minute conversation. And then she'll just be like, hey, one of the partners will call you directly. And then that's what we'll do is I'll go on, and that's when I'll be like, say, what are you going to do with your proceeds? Why are you selling? And then, and you're right, dealing with these smaller properties, it is more the mom and pop. We've come across a number of folks that want to retire. They're older, their kids don't want it, have no interest in it. And so I asked them, hey, have you thought about capital gains? So you're looking how to avoid this? Have you thought about, carrying a note? You own this thing, there's zero debt on it. Do you want a big cap? Here's what we can, offer. We're willing to, what creates that win-win situation. So, and we found a 72 unit. We didn't go to close. They kind of backed out a little bit, just due to family squabbling on their end. But they were going to do, it was a 8% down payment is all they wanted up front. They were going to carry a 25-year fixed rate note and hold it for 25 years. They just wanted, and they at like, we didn't really lock down the interest rate, but it was going to be around that 3 to 4% interest rate. I was like, well, crap, that's, that's good. I'll take that all day long. And I was like, let's go, I'll do this. And, and that deal's not dead. We're still following up, still making calls. And as soon as they get their family, the partners are all of family members. As soon as they get that worked out, we should still be able to pick this property up. But yeah, so there's all sorts of opportunity. With that, we're doing, depending on the deal, we've done JVs, joint ventures, is bringing on a couple folks with some money, especially on these smaller properties, to doing syndication. So it's just depends on the property, the returns, what the business plan is, the market, so we basically look at each deal independently, and then which one makes the most sense.
Yeah, the other thing too, I just want to say about the seller financing, which I think most people look into it that are newer investors and are like, oh, this is fantastic. I can get in less than 25%, right? Or I don't have any money, I can get in with 0, which I don't know if you think's a thing right now. But the thing too is that you can avoid a lot of the fees and limitations when working with a bank. So, when you're dealing with a bank directly, even if you do get it funded, just the prepayment penalties alone. And if you have a 10-year term, you're talking, the step down 5544332211. And you're paying anywhere between 1% and 5% of a prepayment penalty on that loan when you're refinancing or paying it off. And that's something that you can, obviously you're going to word this. It's going to be probably your attorney that's the one that's drafting it. So you can kind of put in what you like, but there's a ton of junk fees, let's say, are eliminated. So it's a true 8% you're putting down. You know what I mean? It's not like I'm putting 25% down, but now I've got 3 to 4% of bank junk fees. So I got to pay the person I'm talking to on the phone. I got to pay the investment committee and the bank, and you're paying points here, you're buying points, you're all this kind of stuff that goes on when you're dealing with a bank. So that's a whole other thing I just want to bring up, that yes, the down payment sounds fantastic and that rate sounds fantastic, because I've gone to people before. Like last year, we were going back, and we're still going back with them, that we made contact with them last year, and it was like we went and offered 5 and they're like, oh, that's a little low and stuff. And it doesn't matter. If you have the prepayment penalty and you can get in there for less than that typical down payment is, right? And it stays off your credit as well. So now it doesn't mark against you as being another debt that you have. So there's so many different pros with the seller financing. But when they've been warmed up from your VA, what are you doing to track them? How is that? Is it already in a CRM? Are you putting it into a CRM from, say, I guess it's like a Google sheet you might give to your dialer? How are you? What kind of system do you have in place to follow up?
No, yeah. So right now we're looking at tweaking this to make it a little bit more streamlined. So within Mojo, when we load up the list, it's like an Excel spreadsheet. So she's able to go in and take notes. And so, yeah, we know who's hard nose, maybes, non-contacts, things of that nature. So we can track. And then what we'll do is we'll take that and I'll actually stream it down even smaller, put it into another Excel spreadsheet, just to keep track. Okay, hey, I contacted on this date, left a voicemail or email, whatever the case, add my notes. What we're looking at doing, is because I just brought in my own CRM through HubSpot, is incorporating that into HubSpot. So I can have so I can get the automatic reminders. Hey, it's been a week. Go ahead and call them back, or whatever the stipulation is. So.
Interesting. Okay. Yeah, we use Podio for when we actually have contact with someone, we'll put into Podio and it'll email you whoever the contact is on that. And you can then log in or go to it and just pop in, hey, when's the next time I want to talk to this person? So it's something, 3-6 months. Then you can always mark how you had contact with them or you didn't, So, because there's some people you email, you never hear back from them. Some of them you text and they're back to you in 5 minutes. So it just depends on people have their own specific medium that they like to converse in, and you kind of have to just follow that. So what you were talking before about managing your deals, you have all third-party management. So are the smaller ones, you're handling more of the asset management, are the smaller ones more time intensive, and are you strategically kind of buying these properties? So if you buy a 20 unit, are you now focusing more on that area to try to get a little bit more scale, or what is your strategy there? Because I feel that it's much more work buying the smaller properties, but like you said, you can get a much lower price. I know in Florida pre-COVID, I had a broker here that was telling me complexes 100 plus units were selling at a 4% premium versus one that was, so it's like crazy. You buy one from 90 versus one that's 110. And you might be paying 4% more just because of so many people, syndicators, that want to buy these properties and will pay more for them because they want the ease of just buying one property. So it's something that you can do it if done correctly. I just want to see what your strategy is there with the smaller properties.
Yeah, I look, definitely economies of scale. So, I'll start out, and I'll pay more for property management for my first property. Because it's a standalone, even for 20 units, I'm gonna get a little bit of a discount, but if I could find a PM that would give me 7-8% on 20 unit, I'd be happy. I got them negotiated down to 9, for initial versus 10 in some of these markets. But yeah, then we will concentrate. We can find them in that same locale. I have no problems owning, 520 units. There's 100 units right there. Yeah. And then guess what? Now I can potentially hire an on-site manager to take care of those, which is going to decrease my expenses. I'm going to have some payroll, but instead of paying 8, 9, whatever percent, now I can manage the manager directly, or I can still have property management do it, but I'm only going to pay 1 or 2%.
Yeah.
So definitely looking at that scalability. And so I don't. You're always looking at your operating expenses, but I also take in mind when I'm first into a market and getting my foot in there, I don't try to get the best deal I can with property management. Yeah. I try to get a good deal. I try to get them down a little bit, but I'm trying to build that relationship of going, hey, all right, do a good job for me. I'm going to pay you well for this. And guess what? You're going to be my go-to. Then once I have 100 units, then you're going to take care of me a little bit more. Because I'm taking care of them as well.
Yeah, it's great. I kind of like the idea. It's a starting point, one thing, but I kind of want to talk to them about where we're scaling at, where's the gross, where's the units that, and, they're like, oh, it's 35 units or whatever it might be. So now, okay, now I've got to get this 20 to 40 units as soon as possible. And I can decrease it. And then that's now you've just got yourself into a competitive advantage against other people, because now you're paying 7% and somebody else coming in is paying 9-10%. So now your management is 30%, 20% less right across the board. And that's a fantastic place to be in. Not that you want to overpay, but you can now go in and maybe sharpen your pencil a little bit more than someone else because of that infrastructure and that scalability that you have in place, which is the best place to be in.
Yeah.
So,
and then, and then it also works on the backside, when you go to
100 units now, not 20.
Exactly. Nice. 100 unit portfolio. Now you're in that. Oh, I can charge that 4% premium.
There you go.
So yeah. So it's yes, scalability and thinking of that, it definitely has its advantages.
Now the thing with that, which is people are like, oh, well, that's on different properties. Well, I mean, if it's within a mile or two or something of an area inside the same neighborhood, it's different. If it's in 20 miles away or something, then it's kind of doesn't really work. But if you're close in there, I mean, that's where you can get that benefit. I mean, that's where you can start. It's fantastic. Yeah, that's the best way of doing it, I think, is where you're going to have the best returns, because that's additional return on it for doing nothing, right? Because you didn't add any more value there per se on an NOI line. You're just adding more value just because someone can come in now and their costs can be a little less, and it's easier for them to manage because you're just talking to one management company, whether it's if they had 100 units all over and they might be talking to several. So,
right.
So what are common mistakes you see real estate investors make?
Oh, man. And I've suffered from it too. I think we all have. I think the two biggest one is basically analysis paralysis, especially on that first deal. And then basically because of that, and really what I'm saying is inaction. So fear. So probably the biggest thing is overcoming that fear, because if you're fearful of making mistakes, then that's where you get analysis paralysis. You start getting, buyer's remorse, or, you start second guessing. So yeah, and that would be going back so that's the biggest mistake. And I'll also go back, and anyone I talk to is like, you know what? Fail early, fail often. And that's, if I could go back, I wish I could fail sooner than I did. Because, I'd be a lot further, because I learned more from my failures than I have from the successes. And, now that I'm, and you get those failures out of the way, and I'm not saying make a big one. If you can make a lot of small failures and mistakes, especially at the beginning, you're going to make less mistakes, and you're going to have more confidence, as you get into those bigger deals and stuff.
Nice. Okay. What do you think are the main factors that have contributed to your success?
Yeah, man, that's a good question. It's funny. I get kind of asked that quite a bit. I boil it down to it. It's my why. Why am I in this? Why am I doing what I'm doing? Also, I think it's my willingness to say yes and then figure it out. Getting over that fear. Abundant mindset. So, when I'm looking at a market, I don't have competitors in my markets. I don't have, other investors. I look at them as future partners, right? Just because we're maybe on different sides of this property, compete, but now I have a new contact, and hey, we have similarities in criteria and stuff. We're looking at this property, hey, let's talk. Let's maybe partner up on one, So keeping that mindset. And then I think another one too is more of an intangible, but I think my experiences in the military, being teamwork. We're constantly in the military. You're taken out of your comfort zone, and you on a deployment, you may deploy with people you don't even know, but yet you're expected in a short amount of time is to congeal as a team. So I think that is helpful, because we know that commercial real estate in particular, it's a team sport. Yeah. So
interesting. Those are fantastic. And as we're wrapping up here, tell us about your 501c3, the Paper Crane Foundation.
Yeah, no, thank you for bringing that up. So it goes with my why, and a little bit more, with the Veteran Pride Investment Group. I donate 20% of my profits, my company's profits, back to first responder and veteran charities. And that wasn't, again, maybe I'm a little impatient. My type A personality to some aspect I wasn't helping as much as I wanted to. So my wife and I, and really her idea, was to start a nonprofit. and it's research based. So when I was exposed to multiple blasts during my deployments, and ended up with a traumatic brain injury, put on a wounded warrior. And we were looking around, and there's a lot of veteran nonprofits out there that are offering experience type retreats. And those are great, but those are short lived. And so we wanted something to go, because I walked with a cane. I had balance issues. I had memory loss. And I'm still dealing with those challenges, but it wasn't until I got the proper help. And what we were doing, or found out when I was finally got the proper medical care, is there's a lot of research that's lagging. There could be more that could be done. So we came up with the Paper Crane Foundation. Is to promote and fund research for traumatic brain injury and post-traumatic stress. And so we wanted to do more. So that's how we landed on that. We're getting ready to kick off this year is a 5 to 7 year research project with a couple other nonprofits that dealing with brain injury. And what we're doing is we're actually in those we're working, we got good funding and stuff with those through grants, but we're kicking it off as the end of this year with a trip to Mount Kilimanjaro. So I'm taking myself, 4 other wounded warriors, actually taking a first responder, a local firefighter, and we're going to summit Mount Kilimanjaro. And this is our kickoff. It's going to raise awareness. And really what we're doing, that awareness piece, is everyone that's going, we've suffered from a brain injury. And so what we want to do is show other veterans, first responders, people out there that, just because you have those injuries, those challenges, doesn't mean you still can't go on and overcome them and still do great things. So that's what we're doing this year. We're really excited about it. And, we're just shy of our goal. So we still, so anyone out there wants to help us to get to Kilimanjaro this year, please come out. We're looking for, we're right there at the edge. So we're going to get there. But yeah, so really anyone who wants to help out, please come support us. At least pass the word out.
Yeah, for sure. I will put the links into the show notes, but let us know how how our listeners can learn more about you and your business. Yeah,
I am readily available. I probably make myself more available than I should. But again, it goes back to that abundance mindset. It's all about networking, building a team, keep moving forward and helping out. So really the best way to get a hold of me is email me. So colby.bowers@veteranpride.org. You can get a hold of me directly, and then we'll set up a call. I'll talk to anybody. You can go check us out on my website, obviously, www.veteranpride.org. And then also on LinkedIn. So I try to post some blogs. I'm behind. I've been busy. So I got to get back up to posting some content. But yeah, anybody, reach out, want to talk. Anyone who wants to get started, want to invest in any of my markets, definitely looking forward to meeting new people.
Okay, awesome. Yeah, I'll put the links to Veteran Pride and also the Paper Crane Foundation, and I'll put those into the show notes. So thank you so much for coming on today, Colby.
Thanks for having me, Charles. Good seeing you again.
Thanks. See you soon.
Hi guys, it's Charles from the Global Investors Podcast. I hope you enjoyed the show. If you're interested in getting involved with real estate but you don't know where to begin, set up a free 30-minute strategy call with me at schedulecharles.com. That's schedulecharles.com. Thank you.
Thank you for listening to the Global Investor Podcast. If you like the show, be sure to subscribe on iTunes or Google Play to get new weekly episodes. For more resources and to receive our newsletter, please visit globalinvestorpodcast.com. And don't forget to join us next week for another episode.
Nothing in this episode should be considered specific, personal, or professional advice. Any investment opportunities mentioned on this podcast are limited to accredited investors. Any investments will only be made with proper disclosure, subscription documentation, and are subject to all applicable laws. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Syndication Superstars, LLC exclusively.